This is InvestTalk. Independent thinking, shared success.
Hi, this is James from California. I have a question on NRG. It's an energy company. Do you think it would be a good investment in the long haul, 5 to 10 years, for dividends and growth? Thank you.
So NRG, ticker NRG Energy Incorporated, is a energy company. It's headquartered in Houston, Texas, and it provides electricity and natural gas to residential, commercial, industrial, and wholesale customers across the United States and Canada. Now, taking a look at its relative strength going back 5 years, you see it started to become really strong headed into the new year. Now, one of the reasons why is because of its exposure to natural gas, and natural net gas names, particularly within the energy industry, have done really well year to date. We hold a couple names that have done very well that are energy names, or rather natural gas names. Now, taking a look at the revenue growth of this name, pretty solid, 24% on an annualized basis going back 6 years, but most of that was really between 2019 and 2021 is where they saw most of their growth. And so growth has slowed, but while growth is slowing, margins are also expanding. They actually lost money in 2023, projected to have made money, 4.5% net margin last year, and that's projected to hold into 2025 as well. Now, they reported better than expected earnings in Q3, which certainly drove some of the positive price performance. But over the last 3 months, they're up 16%, up 15% year to date, 105% over the past year. So seeing all of that, seeing the benefit of their strategic partnerships with companies like Google Cloud and how that's borne out in the stock price, the question is it too expensive right now? Well, it's trading at the upper end of its 5-year range at 13.7% forward-looking price to earnings, about 10 times its book value, about 13 times price to cash flow. And so I see this as a name that is ripe for a pullback. I mean, it's up 4.29% today. The whole market's up pretty much. Energy doing particularly well today. And so, let's see what the breakdown is between oil and natural gas. So it looks like in terms of percentage, most of its revenue is coming from the gas space. And so with the continuation of this trend towards natural gas, towards cleaner energy globally, right, not just in the US, but they service Canada, I think that NRG is one to keep on your watch list because, again, it looks like it's ripe for a pullback. Great company. They're headed in the right direction. It's a great theme to invest in, but I'd wait for a little bit of a pullback, certainly up 4% today, ripe for one in the near future. Thanks for the call. Now, we already answered a voicemail, so why don't we dive into the comment section question bank over from our YouTube channel. While you're over watching our videos, we actually have decided to switch up a little bit the format of how we do our videos. So maybe go check that out if you are into something new. And while you're over there, if you want to leave a question, feel free to leave it in the comment section of our videos. We like to go in there as soon as we can and answer your questions. Now, this question comes from our good friend Brent Jankos, 2046. And it is about ticker EXPI. It says, I'm curious about your thoughts on EXPI. I'm a realtor on the side, and I get company stock as compensation at a discount. The company is continuing to issue more shares by doing this, making my shares less valuable. I would also like an analysis of the company. My percentage is still only around 4% of my overall portfolio. So EXPI is a cloud-based real estate brokerage firm. It is relatively old, right? Founded in 2008. And what the company does is it offers residential and commercial real estate services across the United States and internationally via its virtual platform, which enables agents to collaborate and conduct business without the need for physical office space. Now, its revenue looks like it's grown pretty well over the past 5 years, but most of that in the 2019 to 2021 era. Growth has certainly slowed down. It's down 1.65% year to date, down 15% on the 52-week. It underperformed the S&P 500 by almost 50% in 2024. Now, it looks like it lost money in 23, projected to lose money this year, might go positive in 2025. I'm sorry, projected to lose money in 2024, might go positive in 2025. But looking at it, it looks like cash is kind of flatlined a little bit. Its short interest is incredibly high, 25%. And so overall, what that is telling you is as profitability is slipping, as cash flow is slipping, the market thinks that this name still has more room to run downward. And so if you're asking me if this is the right time to buy in a company that is not making money, but also, I'll say it a third time for emphasis, also trading at 26 times forward-looking earnings, I would say no. If you were calling and saying, should I buy into this name? I would say no. And so you're saying, should I continue to take advantage of this? That's a different question. If there's no holding period on the shares that you can buy at a discount, I don't see anything wrong with, if you can profitably do this, buying at a discount and selling in the open market. But the broader question here is one that honestly was asked by my brother to me the other day. And that question was, should he continue to hold on to the shares that he is being able to buy on discount from his company? And my point to him, and my point to you, and my point to everybody out there, not just Brett, is that when you are getting shares from a company that is also your source of income, now this is your side job, I will take note of that, so it's a little different here. But when you're getting shares from your employer, it is not wise to maintain a high exposure to those shares if it is also the primary source of your income. Because if the company is doing poorly and your shares tank at the same time that you get laid off, you are pretty heavily exposed to that company. So overall, I would advise anybody, as you can, to sell down from your stock options or shares that you've been able to buy in discount, just so that you're not asymmetrically exposed to the risk of an individual company. Now, that's not the situation here. Again, this is Brett's side job. But either way, this is a company that has not been performing well. Its relative strength is slipping. Probably had a little bit of a rise during the pandemic because it's tech-centric. But it's down 50%, or it underperformed the S&P 500 50% in 2024. It's down 15% the past 52 weeks, and it's still expensive while not making money. So on EXPI, I'm going to have to pass. Thanks for watching. Let's go ahead and dip back into the InvestTalk voice bank. You know the number, 888-99-CHART.
I love the podcast. I've been a listener for about 4 or 5 years. I had a question about Lam Research, LRCX. I wanted to get your thoughts on it and if it was attractive to you or if it had to go a little bit lower for it to be attractive to you. And I would like to get a price point that you like. Thank you. Hope to hear the question, answer it on the podcast. Bye.
Well, thank you for being a loyal listener. And no matter how long you've been listening to the show, we will take your question. So LRCX is Lam Research Corporation. Now, Lam Research Corporation is a supplier of water fabrication equipment and services to the semiconductor industry. Looks like analysts have recently downgraded this name on the back of some pretty flat performance over the past 52 weeks. And interesting to note, right, is that you've seen a lot of volatility within the semiconductor space recently, but not much volatility within this name, taking a look at their chart, right? It kind of fell off in July, but it's been ranging around 75 to 80 pretty consistently since then. Taking a look at its revenue growth, it looks like it grew at 9% on an annualized basis going back to 2019, and that growth is peaked out, or rather that revenue peaked out in 2023 and then fell off to about $14.9 billion from $17.4 in 2023. Now that's projected to grow again, though not reach those 2023 highs at the end of this year. And in this time, net income has been pretty volatile as well. But margins have been relatively stable, right? They peaked out in 2022 with 26.8% net margin. But that's supposed to be 26.3% this year. So although revenue has been kind of all over the place, net income has been kind of all over the place, they don't really seem to have some efficiency issues. Now, in terms of valuation, forward-looking price to earnings is 19.5. That's about where it's been over the past 5 years. 18.6 price to cash flow, 6.3 forward-looking price to sales. That's a little expensive. But you know what I do like? I do like that it's a $95 billion company that only has $4.9 billion in debt. I like that they've been paying down their debt since 2019, where it was $6 billion. I like they've been buying back shares. Their cash flow is improving. Their profitability is remaining stable. And so although, their kind of relative strength is just starting to peter back towards even with the S&P 500, I think this is a name that is probably fairly valued, whose growth looks pretty solid, that pays a modest dividend, 1.23%. Not a lot of short interest out there. Buying back shares, earnings upgrades. That would be ticker LRCX. I like it. Thanks for the call. 888-99 chart is the number. We have had no live calls yet today, so I'm getting pretty lonely. So if you have a question out there, want to give it a call, feel free to do it. You have about 30 minutes left in the show. But let's dive back into the YouTube channel question bank for a moment. This one from JLE, Know the Future. And it's about VNQ. It says, enjoy your show very much. Keep up the good work. Speaking of REITs, as a set it and forget it passive income source, what do you think about the ETF VNQ? Now, VNQ is the Vanguard Real Estate ETF. And so when I hear something is from Vanguard, I'm thinking likely passive and pretty cheap. And that's exactly what we're getting here. Expense ratio 13 basis points. What it does is it does a market cap weighted approach of tracking the real estate operation and ownership companies in the United States, those REITs. Well, it's a pretty deep basket, it says, but one difference it makes is it deviates away from the bias that you see within the sector itself towards these specialized REITs and more into commercial REITs. Now, its benchmark is the MSCI USA IMI real estate sector. And it actually deviates from the sector a little bit, or rather from the index a little bit, by underweighting the large cap space. Right, you see about 66% of the fund is in large caps, whereas you see about 78% of the index is in large caps. Now, the reason why could be because of what it's holding, right? Only 84% of it is in equities. So I'm curious if it's holding some sort of, this is likely, does equity other you see here, if you're looking at home, equity other could be some sort of futures contract that is tracking an index because maybe they just wanted to equitize cash for some reason. Who knows? It also could be that this fund was raising cash for distributions at the end of the year because they do report. I guess this is as of the 29th of November, so that's not it. But still, this is likely going to give you some sort of exposure to the real estate sector. And so when you take that into consideration, these weights that we see here in terms of market cap distribution, it's probably about even with the index that it's trying to track. Again, you know what you're getting when you buy a Vanguard fund. Large, $33 billion under management for this particular fund. Diverse, 160 holdings. Likely passive, like this is, and likely cheap, like this happens to be. And so if you're trying to get that passive REIT exposure, I think VNQ is a perfectly fine way to do it. Let's keep things moving and pivot back to the InvestTalk voice bank for a question that came in earlier from Ohio.
This is Tyler from Ohio. I just had a question about one stock, Rowe Price, ticker symbol TROW. I just wanted to get your opinion on it, and if you think this is a good time to get in, or should I wait a little while? Thanks, guys. Let me know.
Let's take a look at Rowe Price. They are an investment management services company. It looks like 89% of the revenue comes directly from that investment advisory. And so when you're taking a look at any asset manager, it's incredibly simple to understand their revenue stream because it is going to be some sort of fee relative to the assets that they have under management. And now revenue growth wasn't really robust over the past 6 years, though it started to pick up a little bit, up from 6.4 billion to 7.1 is where it's projected to be when they report earnings in about a month. And that's still projected to grow again in 2025 to 7.5 billion. But as you see with a lot of these asset managers, a lot of these investment services companies, pretty solid margins. They peaked out in 2021 at 39%, but still almost 30% is nothing to be ashamed of. Now, cash flow, though dropping off into 2023, started to improve again. It's a big dividend payer, about 4.4%, which is where it's been for the past 3-4 years. Its dividend per share has been consistently growing from $3.04 to particularly $5 per share this year. There's a bit of short interest out there, about 4%, but nothing too crazy. And they don't have much debt, about $364 million on a $24.9 billion company. But as I mentioned, when we first started looking at this name a couple minutes ago, anytime you're thinking of an asset manager, you have to be very cognizant of its revenue source. It's AUM. And as of the end of last year, AUM declined by 3.6% to $1.61 trillion. A lot of net outflows. And so when you have net outflows plus fee compression, you have declining revenue, you have declining income, right? You have declining margins as well. Because if your fees are compressing, your revenue is compressing, your overhead's probably still the same, right? This is an incredibly scalable business. And so you look at this and you see 12 times forward-looking earnings, and you see 2.4 times price to book, and you think that's pretty cheap. But the trend here is not great. Now, it's up 1% today because banks had pretty solid earnings. Asset managers, IBs, banks did very well. But it underperformed the industry by 31% last year. 31% the year before, 17% the year before. And that's because of the declining revenue and declining AUM, a trend that I don't necessarily think has been broken in the past 15 days. So for T. Rowe Price, that's ticker TROW, gonna have to pass. Thanks for the call. Now, we talked a little bit about asset managers, and we'll talk a little bit about banks later, but also within the financial realm, something that is important to talk about is the private credit market. And that's because it could be headed towards some pretty turbulent waters. Now, Nick Mokes, the chief investment officer at the Wellcome Trust, warns that loose lending standards and, more than anything, a flood of capital into private credit could lead to significant losses if the U.S. economy enters a recession. Now, is a recession likely in the near term? Probably not, but we cannot continue a cycle of boom without any bust. And so, speaking to the Financial Times, Mokes noted that while private credit is less systemically risky than traditional bank financing, the rapid expansion of the market has reduced checks and balances, right? When something is private rather than in the public sphere, there's a little bit less oversight. Borrowers, particularly in private equity, have accessed large amounts of money under some pretty lenient terms, I would say. And so if economic conditions deteriorate, if they worsen to a great deal, investors in these private credit funds, which have really taken a hold recently, could face potentially substantial losses. And he's not alone. Rating agency KBRA has also echoed these concerns, predicting that this year is likely to see a 50% increase in private credit defaults. The default rate expected to climb to 3%, up from 1.9% last year. One of the reasons, higher than expected interest rates, driven in part by a pause in the Fed, but also a part in the Fed trying to determine what the policy shift under President-elect Donald Trump could mean and how that has squeezed corporate borrowers and increased the risk of financial distress. Now, Mokes also highlighted some structural issues within the private credit ecosystem. There's a rise of large, diversified asset management firms that really dominate the space. And these firms often lend to each other. And this creates this circular dynamic, which helps to exacerbate risk, but also hide it a little bit. And so while the structure insulates the firms, the risk doesn't fall on the firms themselves, they fall on you and me. So while private credit continues to grow, the risks are rising. And as it's proliferated and more retail investors have gotten a piece of it, well, typically private things move into the public sphere when returns are starting to decline. This is what we're seeing as well. And so while private credit markets' rapid expansion has raised questions about sustainability, particularly as economic uncertainty looms in 2025, it necessitates a conversation that we are having now, which is part of investing is not just about seeking those returns. And private credit had a good couple years, but understanding the risks of holding and what that risk means not just today, but through the entirety of the economic cycle. This is InvestTalk. Let's play another caller question now.
My question is about Palo Alto Networks, stock ticker PANW. I was just wondering what your opinion is on future performance of the stock and if it's continue to hold the stock or sell it and kind of take the benefits that I've gained over the years. Thank you.
This is the one that we actually haven't gotten a question on in a while, but Palo Alto Networks is a cybersecurity company. So they specialized in advanced firewalls and cloud-based security solutions. Now, taking a look at this company, it is performing pretty poorly year to date, though it's only been 15 days, down 4.27% since the start of the year, only up 7% on a 52-week basis, though. In 2024, they outperformed their industry by 5.2%. In 2023, they outperformed it by 56%. And they've been positive since 2019 relative to their industry. Overall, last year, they actually performed in line with the S&P 500. And a lot of that is because of this revenue growth, right? From $2.9 billion in 2019 to $8 billion last year. That was 22%, 22.6% on an annualized basis. Now that's fallen off a little bit, right? They're supposed to grow from 8 billion to 9.1 through their fiscal year end, which is July 25th. But how those margins looked? Well, they actually didn't make money in 2019, 2020, 21, 2022. They started making money in 2023. And since then, margins have climbed from 6.4% to 32% last year, projected to be 24.4% this year. And cash flow looks pretty solid as well. Right up from operating cash flow, up from 1 billion to about 3.25 billion this year from 2020. They have very little debt. It's a $111 billion market cap company. They got about $1 billion in debt, and they have been paying it down. In 2021, they had $4 billion in debt. So they did use that revenue to pay down some of those debts. But the other way that they've been operating is issuing a lot of shares, up from 580 million shares outstanding to 660 million this year. As a lot of these firms do, they do not pay a dividend. They have not paid a dividend. They have not announced any dividend in the future. Now, they did report better than expected revenue of 2.14 billion and better than expected adjusting earnings for the first quarter of their fiscal 2025. Again, their fiscal year ends in July of 2024. So their Q1 of 2025 is actually the last year. So with all that in mind, what does it look like on a relative valuation basis? Well, if you're looking at my screen, you probably already saw it's trading at 51 times forward-looking earnings. It's trading at 18.9 times book value, 37 times cash flow, 14 times sales. Those are pretty big numbers for me to say all in one breath. And so although revenues look good, cash flow growth has looked good, paying down debt is good, issuing shares, not so good. The biggest worry here is that it is incredibly expensive. About where it's been over the past 5 years, but that doesn't make it not expensive. And so if you've had a lot of gains, I would take some profits. I would have been taking profits probably last year as well in the run-up. It's down about 6% over the past 3 months, up 2% today, but again, most of the market is. Either way, wouldn't open up a new position, would definitely take profits and try and find something that's a little less expensive. Thanks for the call. Let's play two in a row because we got time from 888 and 99 chart.
This is Adam from St. Paul, Minnesota. I had a question about ticker symbol GNRC. Been a long time listener, trying to get better at thinking ahead, and just wanted to get your perspective on the company's fundamentals. Thanks for everything, and look forward to hearing your answer on the show. Thanks.
Let's take a look at GNRC, Generac Holdings. Generac, spelled Generac, is a leading manufacturer of backup power generation products and other engine-powered tools in both the residential, industrial, and commercial markets. It's up 29% in the past 52 weeks. Pretty solid, up 3.28% year to date. It's actually down today while most of the market is up. And one of the reasons why it probably didn't perform as well in 2022, headed into 2023, is because revenue has started to slow substantially, right? From 2019 onward, about 14.7% on an annualized basis. But in that time, net income has fallen, right? From $533 million in 2021, projected to only be $334 million last year. And even though it's going to grow again to $431 million, it's still down from where it was in 2021. Now, some of the reasons why could be, well, a lot of people were working on remodeling homes. A lot of products were being bought for home care, for home improvement. But either way, that's certainly not a trend that we like. Now, cash flow looks to be improving. Shares have been bought back against something we like. It's a $9 billion company with only $1.5 billion in debt. And with all that in mind, it's still trading at 19 times forward-looking earnings. It's trading at 13.5 times cash flow, 2.3 times price to sales. Honestly, it seems to me like maybe during the pandemic era, although their margins were higher in 2019, but still, they didn't do too well coming out of the pandemic, and margins haven't quite recovered yet. And neither is revenue growth. And so I see a name that, although cash flow is improving and they're buying back shares, not a lot of great revenue growth out there. They haven't been able to stem the tide. And so for now, I'd probably keep it on my watch list. That is ticker GNRC, Generac Holdings, Inc.
Hi, this is Austin. I had a friend that had a lot of stock in a company out of Tulsa, Oklahoma, AAON, ticker AAON. He was freaking out about the stock coming down. I seem to think that it looks maybe like a buy opportunity, but wanted to get you guys' professional opinion. Thanks so much for your podcast. It helps me out a lot.
Take a look at AAON. It certainly has not been coming down recently. Year to date, it's up 10%. In the past 3 months, it's up 17%. And it's up 1.44% today. So ticker AAON, AAON Inc., is a manufacturer of heating, ventilation, and air conditioning, so HVAC equipment for commercial applications. And the reason why it's been doing well is, well, they reported a 31.47% increase in revenue in Q3 2024, which blew away market expectations. They're set to report again in February, so we got a little bit to go. But also that the company's growth is really driven by the AI-led demand for data centers and unleashing tech in what is likely to happen this year. And unleashing growth in AI could lead to this continued demand in data centers and therefore the demand in these HVAC systems. And you see it in their revenue, right? You see it in their 21% growth on an annualized basis. You see it from the $888 million to $1.2 billion in just 2 years. You see it in their net income growth, up 33% on an annualized basis. Their margins in this entire time have been growing and really staying stable. 15.2% net margin in 2023, 15.3% in 2024, projected to be 15.7% this year. Their cash flow has improved as well, and they have very little debt, really no debt, $88 million on a $10 billion company. So their balance sheet is certainly sound. They've issued a little bit of shares, few shares here and there, up from 78 million to 81 million, but I mean, that's really nothing. And they actually do pay a dividend. About 25 basis points is what the dividend yield is right now. And that dividend per share has grown from 2019, up from 21 cents to 32 cents. Listen, this is a great company that thematically works well in one of the secular growth drivers that has been driving the market the past couple of years. My worry is that it's really expensive, right? It's trading at 43 times cash flow, 8.8 times sales. In order to justify that, that's some pretty heavy growth over the next 5 years. It could achieve it, but still, Not only is it expensive, it's also expensive relative to where it's been the past 5 years. So if I was trying to get a position in AAON when it's already up 10% year to date, it's up 83% in the past 52 weeks, I'd wait for a little bit of a pullback. I think that is probably likely to happen as these valuations look a little stretched to me. Thanks for the call. Now, before we head off, I wanted to dive in a little bit deeper into the data that came out today. The U.S. stocks saw their strongest rally in over 2 months today, driven by softer than expected inflation data and robust earnings from major banks. These gains mark a pretty sharp rebound after weeks of market volatility, and it comes on the back of the December Consumer Price Index, which revealed that while energy costs pushed prices higher, underlying inflation continued to ease. Combine that with less than expected rise in PPI earlier in the week, and the data really start to suggest that inflation may continue to cool. Now, investors responded obviously positively. And the reason why is they hope that this ease in inflation will allow for additional Fed cuts this year. And adding to the market optimism, aside from the inflation point, were strong quarterly earnings from major banks. JP Morgan reported record annual profits. Wells Fargo exceeded expectations with a boost from investment banking, and Goldman Sachs posted its best quarterly performance in over 2 years. And because of this, bank stocks rallied sharply. The S&P 500 Bank Index up 3.37% today. Treasury yields also dropped from recent highs. And so this adds another layer of positive sentiment to the markets, which has been under pressure from uncertainties surrounding inflation and changes in policies. Certainly all eyes will be on Scott Bessent's confirmation his confirmation hearings tomorrow to discern what may be coming on the tariff front. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family members about our free podcast downloads on iTunes, Google Play, and Spotify. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. We can also help you optimize the potential of your 401k. It all starts over at investtalk.com. Just click the portfolio review button. This is a free and confidential service. Independent thinking, shared success. This is InvestTalk. Good night.